Good morning. It's Friday, the 17th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Our top stories and themes for the day. The Indian stock market's whipsaw. The Dow Jones hits an all-time high and crosses 40,000. Steel companies want more tariffs on Chinese imports. Mahindra says it will invest in electric cars. Volkswagen says it's pulling back. Silver is back in the reckoning, hits all-time highs too. Where could it go next? Why businesses have to think of and invest in disaster resilience in future.
This is a call report with Govindraj Ethiraj.
The markets are on a wild ride. The stock markets are increasingly seeing same-day swings, including yesterday with the BSE Sensex oscillating 1,220 points during the day on Thursday. The swings are obviously reflecting the nervousness at this point arising from the inability of the market to get a precise read on the political temperatures. The market, as we've discussed, has priced in a BJP victory, but is now manifesting the same nervousness the ruling party has been manifesting and transmitting it through its public utterances. While the jitteriness has reduced, possibly because some internal exit polls may have given them some confidence, it's still there. The ruling party's senior leadership has also taken to talking up the market directly, which is usually not a good idea. Just a few weeks ago, there were rumors, subsequently quashed publicly by the finance minister, that there could be an increase in taxes on income from stock market transactions. While any government would be itching to increase taxes, doing so obviously would cause markets to fall. Conversely, if there's the likelihood of a reduction of taxes, which is the capital gains on income earned from selling shares, then the market could surely go up. The BSE Sensex swung, as we said, 1,220 points during the day before closing at 73,663, up 677 points, while the Nifty 50 closed at 22,404, up 203 points. In doing so, they closed at the highest level in 7 sessions. To get a sense of how markets moved this month, they fell over 1,800 points till the 9th of May and then regained all the lost ground, having risen 583 points in 4 sessions. On the National Stock Exchange, the Nifty 50 pulled up about 243 points during the same period. In the global markets, it's all good or great news, depending where you are. The Dow Jones has hit an all-time high, but more importantly, crossed the 40,000 mark. The Dow Jones shot above 40,000 for the first time as the bull market marched higher on bets that inflationary pressures would ease and interest rates would come down. The Dow was up during the day at about 83 points. At the high of its day, the average touched about 40,051, the culmination of a bull market that began in October 2022, according to CNBC. So, this S&P 500, the Nasdaq Composite, also hit all-time highs. The Dow has climbed now more than 6% this year, while the Nasdaq and S&P 500 are up 11% each. Adani comes under fire. Meanwhile, Norges Bank, Norway's central bank, said on Wednesday it was excluding 3 companies from its government pension fund due to ethical considerations. The companies are India's Adani Ports and Special Economic Zone, United States-based L3 Harris Technologies, and China's Weichai Power. Adani Ports was apparently excluded due to the fund's concerns about its potential contribution to serious violations of individuals' rights in situations of war and conflict. Now, this has, of course, increased the size of the cloud that's already hanging over the company and group, particularly since the Hindenburg research revelations broke in January last year. But the group appears to have weathered that, which is the Hindenburg research report, and everything else, and investors also seem to have priced in a degree of perhaps non-transparency in the company's ownership and some balance sheet issues in pricing the stock. Silver hits new highs. Unlike gold, silver prices are being also driven by industrial applications or the potential of it, which includes renewable energy and energy in general. And that adds up to almost half of new silver processed, which means more than half or almost half of new silver that's processed in the world is going towards industrial applications. Silver prices on Thursday hit a fresh all-time high of about 87,400 rupees per kilogram after sustained buying in that metal. Silver is already up about 8% and 6,600 rupees in the month of May. Silver is obviously catching up or staying in step with gold, though the applications and demand drivers are different, as we've been discussing on the core report. Though there is a thread of geopolitics in both, as I can see, because gold for sure, and that's because central banks are buying. Also, there's a metals boom on. For example, with copper, which also we've been discussing here. With metals prices rising, speculators are apparently training their guns on silver too. A report in the Economic Times says investors should also consider that silver prices can be highly volatile due to speculation, which can lead to short-term price surges. Silver is one of the most volatile precious metals, and its volatility can be twice or thrice greater than gold on some days, an analyst quoted by the Economic Times says. I reached out to Sugandha Sachdeva, founder of the Delhi-based SS WealthStreet, which specializes in commodities research, and I began by asking her what was going on in silver.
You see a stellar rally which has come in silver prices. It has been moving in tandem with gold prices, which have also hit a record high this year. So silver prices in the international markets are at the high which we saw in 2013. And in the domestic markets, we have already seen record highs. So basically, the reasons behind the surge in silver prices is this strong demand scenario. As per the Silver Institute, silver demand is expected to rise by around 1% this year, hitting a high of around 1.2 billion ounces, which is the second highest level on record. And besides this, the silver market has been in a structural deficit situation for last 4 years. Even though on-ground inventories are ample as of now, but then the market has been in a deficit scenario. Besides, the usages of silver in industrial applications, and especially the green energy initiatives, have been rising significantly. So last year also, the industrial demand grew significantly, and this year also, it is expected to rise by around 4%. So it's basically the strong industrial demand. We have already seen a strong rally which has come in base metal prices, be it copper or zinc. And silver is also following both of these metals. And alongside this, it is taking cues from gold prices also. So there are a lot of dynamics which are currently shaping the trend of silver. And it's actually a blend of several factors. So on one hand, you have interest rate cut expectations this year. And yesterday also, we saw strong gains coming in after the soft CPI data print from US, wherein the inflation has softened slightly and which has actually increased the bets of an interest rate cut by the US Fed in September meeting. So Fed has actually maintained high interest rates in July 2023, which is almost at 23-year highs. So now there are expectations that the US Fed is likely to embark on a monetary easing path. So that has actually led to a drift down in dollar index, which buoyed gold as well as silver prices. However, if you see prices are still facing a strong hurdle at levels of $30 per ounce, prices have not been able to move past that level. Once we see a breakout above $30 per ounce, we can see a further rise in silver prices. So that could mean levels of $34 per ounce as well from a longer term perspective. And if I talk about domestic markets, one needs to keep a close eye on the level of 87,500 odd levels. In case we see a closing above this level, we are likely to head higher towards initially 92,000 and then 95,000 odd levels as well. However, I think there is some lethargy which is setting in prices. And today also, we have seen that dollar index has kind of shown some rebound on back of mixed economic data from US. And also, Fed officials have hinted that inflation is not easing as per their expectations, and it is a slow path towards disinflation. So that means higher for longer interest rates. So that can certainly put some cap on silver prices at higher levels of $30 per ounce. And in the domestic markets, 87,500 mark could act as a very strong hurdle area for prices.
Do you feel people in India, that's those who buy silver for, let's say, other reasons like ornamental and so on? I mean, is there like a psychological mark at this point at least?
I think so. Yes, it is a psychological mark. And since gold prices have risen significantly, so people actually look for a slightly lower ticket purchases. So they flock onto silver. Plus, silver has been an undervalued asset for a very long time. And that is also the reason investors are actually flocking onto silver. And there is strong demand from China also. So all of these reasons are buoying prices. But then I feel some lethargy is setting in prices. There is some froth in prices at the current levels. Unless we see a breakout above $30 per ounce, there can be some cooling off in prices. On the downside, I see a very strong flow for silver prices at $26 per ounce. And in the domestic markets, 80,000 mark is likely to act as a very strong support area.
Right. Sugandha, thank you so much for joining me.
Okay. Thank you, Govind.
fear of Chinese steel imports into India. So tariff wars are rarely between just two countries. The US is imposing tariffs on China, on steel, and for that matter, electric cars, and that's bound to create more supply at potentially lower prices because of the sheer volumes at which China produces. India's steel industry, already on the back foot thanks to cheaper imports, is now worried about a surge in shipments from China after the United States imposed tariffs on Chinese steel, according to industry persons who spoke to Reuters. On Tuesday, US President Joe Biden unveiled steep tariff increases on several Chinese imports, including steel and aluminum. The Indian Steel Association Secretary General told Reuters that India was already under grave threat of import because all major steel-consuming economies were shutting their doors on these steel-producing countries. The ISA, or the Indian Steel Association's members, include major steel companies like Tata Steel and JSW Steel. China's export push is also obviously being driven by weak demand at home, but China also then is the world's largest producer, like in many other products. Now, while India has been steadily raising tariffs in the last decade or so, producers are also constantly asking for more tariff barriers and thus protection. Unusually, the government is resisting calls for more import curbs in steel, understandably because there is very strong local steel demand, which is of course linked to the massive infrastructure investment in recent years and continuing. The numbers are small though. India imported close to 3 million tons of steel from China last year, and the total consumption of steel that's domestic is about 136 million tons, and the number is rising. It is 13% more than the previous year. More shifts in the electric car space. Mahindra said on Thursday it will invest about 12,000 crore rupees in its electric vehicle unit, Mahindra Electric Automobile. The announcement came on the back of strong results, with standalone net profit for the company rising 32% in the March quarter to about 2,000 crores. Standalone revenue from operations for that fourth quarter rose 11% to 25,000 crores. Now, elsewhere in the world, demand for electric is still weak and affecting most car companies' outlook for electric. Earlier this week, we reported on how Ford Motor is losing $100,000 per electric car it makes. I repeat, per car. And now news is coming in that Volkswagen's all-in on electric vehicles plan is no more. Volkswagen is also present in India, though not in electric. The German car major, which apparently earlier pitched its ID family of electric cars as central to its future, said last week it will need more plug-in hybrids as EV sales decelerate, according to Bloomberg. Volkswagen has also shelved efforts to seek outside investors for its battery unit and scrapped plans for a $2.2 billion EV factory in Germany. Interestingly, or perhaps not, Volkswagen's internal combustion engine cars are apparently doing quite well. So much so that it's on track to overshoot its emissions allowance next year, which in turn is leading its CEO, Olivier Blum, to ask the European regulators for leniency. 3 years ago, says Bloomberg, Volkswagen was on a different trip. It lobbied so aggressively for electric vehicles in the EU that it started fights with all its peers in the region. Now, not only are manufacturers scaling back, but countries like Germany and Sweden have seized or pulled back subsidies for electric cars that still tend to be more expensive than their internal combustion counterparts. Gaps in public charging networks also continue to turn off potential buyers, says Bloomberg. Among others, Mercedes-Benz Group has stopped developing underpinnings for new electric luxury sedans to save money and plans to sell cars running on gasoline longer than expected. BMW, which has had more success selling electric vehicles than its German rivals, still warned this week that the EU's plan to effectively ban new combustion engine vehicle sales by 2035 will hurt the industry. The slowdown has also obviously dealt a serious blow to Tesla, says Bloomberg, which has lost about $235 billion in market capitalization this year, more than triple Volkswagen's current valuation. Disaster resilience, why businesses and governments have to focus on and invest more in it. In February, the Reserve Bank of India issued draft guidelines called the Disclosure Framework on Climate-Related Financial Risks 2024. These rules, when they kick in, will apply to commercial banks, financial institutions, and large finance companies from the year 25-26, and large cooperative banks could follow a year later. The disclosures will need to be published as part of banks' financial results and also be made available online. The draft includes requirements on how banks should detail their use of scenario analysis as well as their setting of internal targets and progress towards meeting any legal targets. The larger point here is that climate change is now a recognized and finite factor in business decision making and will increasingly be so as banks step in. A parallel stream of efforts have led to the creation of the Coalition for Disaster Resilient Infrastructure, a partnership of national governments, United Nations agencies and programs, multilateral development banks and financing mechanisms, as well as private sector and knowledge institutions. Before I go further, let me use an example. The flooding of Dubai airport was a climate disaster for which there was no preparation or anticipation as such. In future, funding for such projects would ensure that climate and disaster risks are built in. Equally, governments are working on doing the same for public infrastructure, which is to build in disaster resilience. A key factor here, therefore, is awareness and, of course, adoption. So I reached out to Amit Prothi, the Director General of the newly formed CDRI, and I began by asking him to take us through what transpired in a recent gathering of countries and entities in Delhi around this initiative and what he felt was the role of businesses and financial institutions in gearing up for this new normal.
As a new coalition, which is about 4 years old, just the fact that we organized our 6th conference in Delhi last month and brought together about 400 participants, including from 40 countries, 1,500 people online to have a discussion on, the topic this time was on investing for resilience. And since you were part of some of these conversations, I think we have a lot of global conversations going on right now where we are talking about we need more financing for infrastructure, or we need more financing for adaptation. We need projects that need to be developed so that adaptation finance can be directed towards them. Finance is not going to some regions that are more vulnerable. So there's a lot of global narratives in the space of resilience finance that are ongoing. And as a coalition that has now 39 countries and 7 organizations, we wanted to bring together both experts and members to see how they're looking at the whole role of financing resilient infrastructure. So certain things came out. I think the gaps in understanding came out very clearly. For example, do we have the right tools to understand how infrastructure is at risk in the future that can then inform investments? Or do we have investment mechanisms right now to take into consideration risk information? So on one side, tools, on the other side, our cost benefit analysis, our financial metrics, do they actually take into account physical risk, etc.? So as a coalition, it was important to bring in experts from, the insurance industry, from public sector, from private financiers to have a discussion. And a number of key points have come up. For us, for example, the whole role of data is incredibly important. And as a coalition, we want to see how we can put risk data in the public domain that can be used by the public sector, can be used by the financial sectors. We want to put forward frameworks and methodologies when we're looking at, for example, power infrastructure or telecom infrastructure. How do you factor in risk at the early stages so that when you're investing in something, you've understood that, my power system that I'm investing in will remain disruption free for my projected cash flow, right? So we try to bring certain methodologies and frameworks also into the public domain. There's also a discussion on the whole role of labels. How can labels give confidence to the market that something you're investing in is resilient and hence will be disruption free over a long-term period?
If you were to pick on a couple of examples where, let's say, we could see more data being shared in public domain, which in turn would inform people better, what would they be?
So, we've actually put out a global database of risk for the entire world in the infrastructure sector. So we've actually looked at 8 infrastructure sectors, and we've looked at risks of cyclones, flooding, earthquakes, landslides, tsunamis, and drought. And what we are able to say is, you have to understand when we're understanding risk, it's no longer about past history of events. It's actually now projecting how risks profiles are changing. So we've done that. It's a heavy-duty modeling exercise. We've used some of the best modelers out there. And we've modeled risk so that we can actually now talk to a telecom industry and say, in a particular country, the telecom industry faces risks from flooding, landslides, does not face risk from earthquakes. This kind of nuanced modeling has always been in the private domain. Insurance companies do that, but that's not in the public domain. So it's only accessible to people who pay for it. From our point of view, we are saying, let's make sure that this information is in the public domain. And we have a model called GIRI that is now, it's actually starting to get used by different organizations. Other organizations are doing it, as well.
Yeah, so that's your global infrastructure risk model and resilience index. So now in India, you said you've looked at multiple infrastructure areas. Some of them obviously directly relate to India and India's conditions. But anything that stands out where you feel in India, let's say policymakers or even particularly state level or city governments should be looking at?
So I'll just use an example of a power study we did in the state of Odisha. We looked at how the coastal risks are changing because of cyclones. Cyclonic patterns are changing, wind speeds are changing. So we did a whole modeling exercise to understand how wind speeds are changing, and then looked at assets that the power sector holds. This could be transmission lines, this could be transformers, and we looked at within 60 kilometers from the coastline to understand each asset, what is the risk that asset may be facing because of either flooding or changing wind speeds. Based on that, we've come up with a set of recommendations for the government to say, look, if you're going to be investing in upgrading, or if you need to invest in upgrading, and these are the priority areas that you need to invest in first. Now, that kind of methodology can be used at city level at different scales. When it comes to infrastructure, a lot of decisions are being made at the state level. So, this kind of information is very useful for states. At the community level, at the city level, there are other decisions that are being made. Flood mitigation infrastructure or other kinds of infrastructure that is more city scale. In that context, it's about, how do you understand in your city where the vulnerability lies and what do you do about it?
How would you rank or rate the awareness and sensitivity in business, in a very broad sense, on these issues at this point? When I say business, I mean in the private space.
Yeah, I think the adaptation or the sort of the resilience related understanding is still very, very, very early stage. When businesses are looking at ESG, they're coming from an ESG framework, and a lot of them are looking at it from how do I reduce my carbon emissions, which is essentially for mitigation. That's climate has two parts to it. When we talk about climate change, we're talking about mitigation. So how are you reducing greenhouse gas emissions, but also adaptation, where you're recognizing that, the planet is getting warmer. And because the planet is getting warmer, we may be facing more flood events. We may be facing more cyclonic events. I think the private sector actors are still not completely comfortable in the adaptation space. They haven't yet understood. And we saw an example from Dubai last week, right? The airport, which was built with, by the private sector, or I suspect a lot of private investment in the airport, may have not have had factored in their early analysis that the airport may be flooded and hence their cash flow would be impacted. So for the private sector, I think they have to start understanding that cyclones, floods, etc., the patterns are changing, and how do they incorporate that into their decisions? It's still early stage.
Right. And we've seen a policy move in the form of the Reserve Bank asking banks to stress on more disclosures when it comes to climate. Now, that's one aspect. The second aspect is, how do you see the arc between, let's say, disaster resilience, which is the extreme case, and adaptation and mitigation on the other?
It's not necessarily this or that. I think because a lot of these are complex challenges and linked to each other. So, for example, when you're investing in solar farms for your electricity grid, if you're locating your solar farms in a floodplain and you get impacted, that's a situation where it's, the infrastructure would have served the mitigation side of your addressing mitigation, but you got impacted because you hadn't factored in risk of disasters. So the adaptation side was forgotten. When we look at disasters for CDRI, what we have, because it's disaster resilient infrastructure, disasters are about 70% today emanating from climate-related challenges. And 30% are actually from still your earthquakes or landslides that are not climate-related. So we're not very far off. If we say we focus on adaptation, if we focus on resilience for adaptation, we're addressing 70% of the challenges that we're going to be facing in the coming decades.
Right. The Reserve Bank of India's policy framework, which seems to be responding to this larger issue, how do you see that at this point, and what more could it do?
So I think disclosure is a great way to start, right? Essentially starting to raise awareness that if you have assets, if you own assets, what is the risk to those assets? You need to understand and disclose, because you're asking investors to invest in your portfolio of investments. And unless you've disclosed the risk, you're not sharing information, right? So from that point of view, I think it's incredibly important. I think disclosure can also help to then the decision maker can decide if I can reduce this risk, my portfolio is actually going to be much more give me much better returns because I've understood the risk and I've addressed the risk. That addressing the risk part needs a lot more effort, capacity, innovation, etc. And that's again another opportunity. You can start innovating to reduce your risk, and that can spur another industry. So I think disclosure is a fantastic way to start. Of course, it's step one in a series of steps.
Right. Amit, thank you so much for joining me.
Thanks so much, Govind.
And before I go, here's some feedback from all of you friends who've been listening in and very kindly have been sending me some feedback. So let me pick a few today. Aryan says that episode 289 was a good one. Weighing in on the trade deficit that India has, he says he doesn't think it's a negative thing. It's just a way of saying that India is generating great demand for goods all over the world. Hena Nagpal says, I love your episodes, very insightful yet crisp. Thank you. If you have any feedback or thoughts on today's episode, you can write to me at feedback@thecore.in or leave a comment in the Q&A section on Spotify. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.